Good morning, Richard Calhoun with Creekside Realty here to discuss the Silicon Valley and the Greater Bay Area real estate market, week number 13. We'll come back to this slide in a little bit. This is the first heat map. This is showing days of unsold inventory. And yes, the vast majority of Silicon Valley is in red in color, which would indicate a seller's marketplace. You can just look at the numbers over here. Most of the numbers are less than 20 days, or at least around 20 days, 19 days, 24 days. Basically, anything under 42 days is red in color to some degree. The redder the color, the faster the marketplace. Basically, the only exception that isn't in a seller's marketplace is the expensive areas in San Mateo County. Places like Menlo Park, Atherton, Woodside, Portola Valley. Moving on, this is just a quick little table showing the days of unsold inventory over time. You can see that, on the right-hand side, today's date, we're probably the reddest of all of them. It's been fairly constant in the last maybe 3 weeks. You can see as you go back in time, it was paler. That's just to give you an idea of how it's changed over time. This is for a slide that is pretty good for people that don't understand days of unsold inventory. This shows the time that it takes the sellers that are successful in selling. 75% of the sellers sell faster than this amount of time. If you look at these numbers, the vast majority of these are right around 2 weeks. So 75% of the sellers that list their property are selling in under 2 weeks on the marketplace. Some are selling the first week, some the second. Yes, there's 25% of the sellers that are taking longer, but that gives you a pretty good idea on how fast the market is out there. Asking price reductions. This came up with a client of mine. Aren't prices negotiated once the offer comes in? Well, I think this is saying a resounding no. You can see a lot of the different micro market areas, the seller gets at least, well, they didn't do any price reduction whatsoever. Yes, there are some areas where they took a 3.4% reduction here in like Redwood Cities and San Mateo County. And San Mateo County is doing slower than Silicon Valley or Alameda County. I believe it's all the pandemic related. People aren't not going into work every day like they used to. Areas close to the work centers are less valuable. Buyers are willing to commute a little bit further because they don't have to do it every day, and therefore the close-in areas are less attractive than they used to be, and the further out areas are more attractive than they used to be. This is the overbid. This is when the buyer's offers come in. This requires sale price, so there is about a 5-week delay in finding this information. This is really where the market was 5 weeks earlier than in the previous slide, because the previous slide is just looking at the offers. You can do it as soon as the offers come in. This data, we have to wait for the offers to come in and then the escrows to close. But again, you can see that a fair amount of Silicon Valley and Alameda County are faint shade of pink or faint shade of red, which means they're getting more than 1.5% above their asking price. And you can see the different areas over here, whatever number you want. The only area that I'm seeing off the bat that's getting less than 100% again is the expensive areas in San Mateo County. Everybody else is getting their asking price or above, and that's on average. There are going to be some sellers that are taking a price reduction. There are going to be some sellers that are getting quite a bit higher. This is an average of all the transactions together. This is how common overbidding is. How frequent is it? Basically, you can see somewhere around 2/3 of the sellers are getting more than their asking price. Again, the trend is very clear. Silicon Valley, being Alameda County and Santa Clara County, are pretty hot. Silicon Valley, being San Mateo County, is fairly pale or blue. Again, you're seeing this trend across all the indicators, which is a good thing. You wouldn't want some indicators to indicate one thing and another indicator to indicate the opposite. This is the appreciation. This is since 2015, which were the last 9 months of 2015 to the current 5-week period of time. You can see most of the areas are somewhere just very close to 150. Some are as low as about 135. And some are as high as about 175. There's a little bit of fluctuation. And again, the pattern's almost the same. The areas in Silicon Valley, being Santa Clara County and Alameda County, that are the reddest are the areas that are doing the best most recently. And that's typically what's going to happen. Whatever area is doing the best in the most recent time frame is going to have the best overall appreciation. There's ebbs and flows, and over the long period of time, everything tends to go up at about the same rate. There are long-term changes potentially the pandemic making things more or less convenient on a permanent basis will change the market on a permanent basis. But in general, they go up about the same. Any start point and any end point, there will be variation. Here is looking at the sold price. You can see the red hot areas are also the more affordable areas. There's a movement towards more affordable, less convenient areas. You can see the more expensive areas are on the west side of Santa Clara County and San Mateo County that we're doing poor. The more expensive areas are not doing as well as the more affordable areas. This is a summary of what we went over. You can pick whatever micro market area you're interested in and see the conditions. You have DUI, which is days of unsold inventory, days on market, the 75th percentile. Asking price at the time the offer is accepted to the original asking price, so 96.4 means the sellers took a 3.6% price reduction prior to getting that offer in. Then when the offers come in, they're getting 100% of what they're asking for on average. The frequency of overbidding, only 40% of the sellers are getting above their asking price. The appreciation was 164%, and the median sold price is basically $1.2 million. And you can do that in any given one of the 17 micro market areas. Now we're going to shift gears a little bit. We're looking at the same data set, Silicon Valley being the three counties, Santa Clara, San Mateo, and Alameda. We're looking at single family homes and what some people call duet homes, but not condos and townhouses. Those are excluded. We're looking at a 5-week moving period, initially month by month by month, and then week by week when we get down to 13 weeks or 3 months. And what we're doing is we're looking at the sale price to list price distribution. The closer you are to the red dotted line up here, the hotter the marketplace is. The closer you are to the blue dotted line down here, the cooler the marketplace is. And we'll just step through. The arrows indicate a plateau, now a decreasing marketplace. As you can see, the line that's bold is dropping down. Now we're back at another plateau where we stay for several months. And now we've decreased, and now we're into the weekly pattern. So 11, 12, 10 weeks, 9 weeks, all in a plateau, very low end of the marketplace. And we're about ready to start increasing. Now it's probably the first week of increase, another increase, another increase. Current data and plus 1 week. And you can see plus 1 week and current week are very close together, but it's only 3 out of 7 days. And that's why I left the up arrow. I would anticipate that going up. Basically, I use a real estate fiscal year that starts on March 1st and then is increments of 7 days since then. And then I look back 35 days in the rearview mirror. When I get to February 21st, instead of going forward 7 more days, 1 more week, I jump back to March 1st. That takes care of my leap year and my 1 extra day a year. So I'm always comparing the same dates. They are comparing different days of the week, which is a little bit of a problem because there is a weekly cycle, but it's more important to give people an understanding of where we are instead of shifting back and forth. By a weekly cycle, a lot of inventory comes on the market Tuesday, Wednesday, Thursday. A lot of offers are reported sold Wednesday, Thursday, Friday. Depending on when you look at that, you'll have some of next week's properties coming on the market already without having reported last week's sales. So there is a weekly fluctuation. Here we'll go over the green URL. That's the top one here. That gets you to the YouTube archive. If you add in 2023 Saturday morning at 9 o'clock, you get to this presentation by Zoom. If you add in H for handout 2023 0401 for the D month and day, you'll get the PowerPoint handout slides that we're going over right now. Were posted, so they were there for download. I got them up about 10 minutes before the hour. And to get any specific episode, you add in the year, month, date code. Do I have any questions? And going forward, you can ask questions as we present. I don't see any unmuted mics, so I will proceed. Now what we're doing is we're looking at the active inventory and we're comparing to the 10-year historical. The 10-year historical median is this thin black line here in the middle, sort of right around 2,000 listings. That's the inventory you'd expect to have. The most inventory, which would tend to indicate a cool marketplace, which is why it's the ice blue color, is about 2,600 homes. The least inventory you'd expect is down here around 1,400 homes, which is why it's a red hot marketplace. When you tend to have limited inventory, you tend to have a hot marketplace. And here we are at 1,500 homes. So we're almost having the the lowest level of inventory you'd expect to have for this time of the year. Now we're looking at offers accepted. Same concept. Now with offers, the more offers you have, the hotter the marketplace is. So a red hot marketplace would be up here around 3,000 offers in a 5-week period of time. The typical offers you'd expect is about 2,650. The least number of offers you'd expect to have is down here around 1,650, maybe 1,700. And that's exactly where we are. The purple is the current data, and you can see the current data is basically right on top of the blue line. We're selling as few properties as you would possibly expect. Yes, there's going to be one year where there was less, that's the 90 percentile. And you can see right here is a great example. Here's your blue of above the current year purple. So the current year, the blue is not the worst year you'd absolutely expect, but it's the 10 percentile, which is about the second worst year you'd expect. We're basically tying the second and worst year, or call it the third worst year in the last 10 years, because you have the worst year, the blue line of the data, and then you actually have this data point. And I'll have to check to see if I include this year in the data point, because that may be why the data is on top of one another. Looking at days on sold inventory, which is the ratio between the number the inventory available and the offers. So it's the supply-demand ratio. And you can see right here, you're right on top of the black. Because we have very limited inventory and very limited number of offers, we're having basically exactly the speed of the marketplace we're having. So for the people that are out there, the fast pace of the current marketplace is exactly what you'd expect the market to be. The hottest you'd expect the market to be is down here around 16, 17 days. The typical is right here at 30, which is where we are. The slowest you'd expect the market to be is up here around 38 days. So not a lot of fluctuation, but we're right there in the middle. Now we're looking at the 75th percentile days on market. This is the long typical seller, the third quadrant. How long is it taking for 75% of the sellers to sell? Well, normally in a hot marketplace, you're down here probably around 13, 14 days. You'd expect to be somewhere right around 18, 19 days. Right now, we're at one of the coolest marketplaces. Again, you can see the purple line is right on top of the light blue line, and that's somewhere right around 26 days, it looks like, if I was to guess. In the 3 counties, 75% of the sellers are selling their properties in about 26 days or less. So under a month, you'd expect them to be selling it under 3 weeks, so it's taking a little bit longer to sell than typical. This now is a very extreme benchmark, but you have to do it, and that's because prices are very sensitive. This is the price reductions. This is sellers taking a reduction in their own asking price, and I'm only looking at the largest 2.5% of the sellers. So I'm looking essentially at the 97.5 percentile, the 2.5% of the marketplace that's taking the biggest price reductions. I would normally ignore data that far out on the extreme, but the problem here is frequently, even at 90 or 95 percentile, a lot of time the data is at 100% and you learn nothing. The sellers that are taking the biggest discount right now, they're taking about a 12% price reduction. Their asking price at the time the offer comes in the door is 88% of their original asking price. The coolest you'd expect it to be is up here around 90 percentile, 89.5%. Sellers are taking a bigger discount right now than they typically do, and typical's up here at 93%. The sellers that are come in the marketplace and realize they're overpriced typically take a 7% price reduction. Right now, they're taking about a 12% price reduction. And in a hot marketplace, they're taking about a 5% price reduction. That's not saying that every seller, this is only 2.5%. So 97.5% of the sellers, the vast majority of the sellers are not taking discounts this big. This is the average discount, and now you're going to really see it. In a typical year, you're up here at about 99.8%, almost 100%. And in the hot marketplace, there was a little bit where we were above 100%. And you can see it right here, basically at the beginning part of 2022, and also back here at the beginning part of 2018, sellers were actually raising their asking price. And that happens in 2 situations most frequently. One where a listing agent thinks that, they got an offer in over asking price, and they want to raise the asking price to match the offer so that the appraiser doesn't get wigged out. And I don't think that makes any difference because the appraiser can see what happened. And the other time is when the seller comes on the marketplace and it's just blown away by the amount of activity they're getting, and they increase the price. I have at least tried to remove all the typos where someone put in a property at $500,000 when they meant $5 million. So I've tried to take care of the typos, and there are a fair number of typos on the data entry stuff. So there is a fair amount of work in trying to correct it, and I'm sure a few slip by. But anyway, what you're looking at here is we're now taking some of the biggest price reductions that we have, and the biggest price reductions are still less than 1%. It's not common for sellers to come on their market at an inflated price, and when they don't get an offer to reduce it, because on average they're taking less than a 1%. Typically, as I said, you're up here at about 99.8%. In the hottest marketplace, you expect to be right up here about 100%. This is the frequency of price reductions. So this is how common are price reductions. And in a hot marketplace, only 5% of the sellers take a price reduction. So right there, you can see why I go out on that extreme of 2.5%. If only 5% of the marketplace of the sellers are doing a price reduction, anything greater than 95% would be at 100% most of the time. And you can actually see up here is 10% reduction. So even the 90% is going to be 100% the vast majority of the time. Anyway, so in a typical marketplace, you'd expect about 7.5% of the sellers to be taking a price reduction. And right here, you can see both the coolest and the actual data is up here, probably about 13.5, 14% of the sellers are doing the price reduction. So less than 1 out of 7 sellers are doing any price reductions whatsoever. This is the magnitude of overbidding. This is flipping over and finding out when the buyers actually come in. So now there's a 5-week delay. So what we've been comparing to up to this point sort of gives you an indication of what the market's doing right now. Now what we're seeing is what the market did 5 weeks ago, because we have to wait for the escrows to close. You can see that the coolest the marketplace is about 101.5%, and that's exactly where we are now. Where you'd expect the market to be is sellers getting a 4% above their asking price, and in the hottest marketplace at this time of the year, they were getting about 10% above their asking price. You can see that it's very uncommon for the overbidding to be below the seller's asking price. So it's very important what that initial asking price is. I was doing median overbid, now I'm doing average. Same slide basically, but the average overbid is going to be much higher than the median, because buyer comes in and pays 50% above the seller's asking price. That pulls a lot of people up. So you can see the low expected is about 4% above, the typical expected is about 6% above, and the best above is about 112.25% above. So 12.5% above the seller's asking price. This is how frequent is overbidding. It's sort of interesting. Are we in a cool marketplace or are we in a hot marketplace? We're in an aggressive marketplace as far as speed, but we're not in an aggressive marketplace as far as overbidding. Yet 60% of the sellers, or almost 60% of the sellers, are getting more than their asking price. But that's the lowest you'd expect it to be. Where you'd expect it to be is up here just north of 70, call it 71% of the sellers to be getting above their asking price. And in a hot marketplace, you'd be expecting to be up here somewhere around 82, 83%. Again, it's very common to have overbidding even when the market isn't as robust as it was in 2022. Here's price over time. This is on log scale. I think this is useful when this is the big run up that we had in 2023. You can see the big end of the year downturn, and then you can see that we've come up and we've recovered, and it looks like we're going to start going up. You can't predict the future, but just on the couple data points here, because there's a data point every 7 days, you might expect the rate of appreciation now to follow along that blue line, but remain under the blue line. But anytime the purple data line is below the thin blue line, you'd expect upward pressure on price. You can see that there's a downward turn. I think it's 7 out of 10 or 8 out of 10 years. There's a big down at the end of the year rundown. And even years like here where it's not a big end of the year rundown, there's a little bit. And last year in 2021 going into 2022, the market was fairly flat. And I guess that would have actually been a year and a half ago. So you can see it was fairly flat instead of having appreciation. So you typically have this end of the year decrease. And it's just real estate is an optional event. Families that have a lot of wealth to buy the more expensive homes are more into vacations and holidays. So more of them take time off at the end of the year for the significant holidays. As a result, lower priced homes are what tend to sell, which brings down the price every year. You can see the dark vertical line is the end of the year. The other fainter ones are the quarters. And you can just see the pattern on there every single year, down, 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 and down, 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 flat, flat, down. 8 out of the last 10 years, there's been a major adjustment at the end of the year, and that's the seasonal impact of real estate. This is looking at the 3 counties that make up Silicon Valley. So now instead of looking at them all in a blender, we're looking at them individually. You can see that Alameda County and Santa Clara County are right on top of one another, with San Mateo County being a smaller county, being lower down on the volume. But the real takeaway is Alameda County historically has been above Santa Clara County, and the fact that they're equal right now would probably indicate that Alameda County is a faster paced inventory. Any shortage in Santa Clara County is a greater shortage in Alameda County. I don't have where you'd expect the 3 different lines to be, but let's look at first quarter. So first quarter, you're here at 1,200. First quarter, you're somewhere around 1,200, close to 1,200, close to 1,200, a little bit shy of 1,200, 1,200. Now you get into 2020 and you're way down here at something like maybe 800. And then in 2021, we were way low. We were down here somewhere around 600. And in 2022, which, a lot of people thought was a fantastic year, and it started off fantastic, you're up here around 700, and now you're at 600. If I remember my numbers correctly, we basically are tied for the second slowest year, or the third lowest year, depending on how you want to count. There was 1 year lower. We're tied for third year. County impacted the most would be Alameda County. The next is Santa Clara County, and the county impacted the least is San Mateo County. Because if you look at this, the line here is not that much lower than a lot of these past years. There is definitely an impact difference on how the 3 counties are performing. Now we're looking at the number of offers accepted. You can see that San Mateo County went from maybe just a little bit below 600 down here to somewhere around 300. So San Mateo County is selling about half the homes they typically do. Santa Clara County went from maybe somewhere right around 1,100 homes. I'm trying to bisect the first quarter vertical line, and now you're down here at somewhere around 750. We went from 1,100 to 750. Clearly a reduction, but not nearly as significant as San Mateo County. And again, Alameda County is going to be the highest because you're somewhere around 1,200, and now you're coming down here somewhere around 650, actually closer to 700. So it went from about 1,300, 1,250 down to 650, so about a half. It's sort of the same magnitude of San Mateo County. So Santa Clara County has had the least amount of decrease in the number of offers, and you can see that Santa Clara County is actually above Alameda County in this graph, where inventory, it's the other way around. Days of unsold inventory, you can see Santa Clara County and Alameda County are right on top of one another. San Mateo County is the slowest. If you come back before the pandemic, San Mateo County was typically the fastest pace. So there's a huge, and that's basically the biggest takeaway, is San Mateo County went from the fastest pace to the slowest pace, and the change happened right about here with the pandemic, and it's pretty noticeable. You can say they were all right on top of one another. Here, going back in 2019, San Mateo County was clearly the lowest, and then by July of 2020, right after the pandemic recovery, the San Mateo County was, the highest of the 3. Then they're all on top of one another, so you can't really tell. And now we're coming out again, and San Mateo County is the slowest. So I think that's the big shift. Days on market for the 75th percentile. It's sort of surprising on how close all 3 of these are over the whole time frame. Now we're moving on to the magnitude of list price reductions. This is the list price to the original list price average. You can see that San Mateo County is way down here, taking the biggest discounts at about 97.25%, and Alameda County and Santa Clara County are up here at about 100%. The price reductions are happening in San Mateo County. They're not really happening in Santa Clara County or Alameda County. This is the magnitude of overbidding. This is the average. So this is everybody in a blender. As you can see that the overbidding is the most in Alameda County at 107%. San Mateo County and Santa Clara County are right on top of one another. So even though in the earlier slides it looked like San Mateo County was doing the least well, when you look at the amount buyers are willing to overbid to get a property, they're basically identical. Now we're looking at the frequency of overbidding. Alameda County is the top at about 65% of the sellers getting more than their asking price. Santa Clara County next at about 55%, followed by San Mateo County with almost 50% of the sellers getting more than their asking price. Again, there's sort of this juxtaposition. We have these expectations, but for 50% of the sellers to be getting more than their asking price, you still have a fairly strong marketplace, but the listing agent could be doing a good job of getting the seller to realize the current economy and be pricing the property accordingly. This is price, and I like this. It's on log scale. You can see the huge swing that San Mateo County has done, and it's gone up and now it's coming back down. San Mateo County with the fewer number of transactions, I forgot what the number was, maybe 300, you're going to have more bounce than you normally do. And you can see that the San Mateo County line bounces more than the Santa Clara or the Alameda County, and it's simply to do with your sample size. This huge fluctuation is not to be unexpected, but you can see that Alameda County and Santa Clara County both ran up. You can see that the downturn would be expected, the upturn would be expected. Whether this current downturn, this could be just a statistical fluke, and the depth of this decrease in San Mateo County was probably a statistical fluke, because I pointed it out before that Santa Clara County actually was $20,000 higher than San Mateo County on the median sold price. Here's on analog paper for people that prefer that. I prefer log. This is the appreciation since that last 9 months in 2015. You can see all three counties are doing basically fairly similarly. San Mateo County is the least right now, and it looks like Santa Clara County has the highest, and Alameda County is in between. So there is some difference. You go back just a couple weeks and they were right on top of one another. There's a lot of fluctuation because you're comparing two different things. The reason I took a 9-month period of time was to try to get a rock solid price. And I took the 9 months of 2015 where prices were fairly stable. I tried to get a stable base, and then you're looking at what is happening with the sold price in the past 5 weeks. This is actual data for people that want to see it for the three counties, Santa Clara, San Mateo, Alameda, and combined, you're looking at the number of new listings. We went up in San Mateo County and Alameda County, pretty flat in Santa Clara County. Listing inventory went down in 2 out of the 3 counties. It's up in Alameda County. Number of offers accepted went down in 2, but up significantly in Alameda County. Days of unsold inventory, probably the more important indicator, is basically flat. 5 days is a changing marketplace. And here you're about a half a day in 2 out of the 3 counties. Then you get down to the 75th percentile days on market, 22 in Santa Clara County. So it's the fastest marketplace, followed by Alameda County for 25 and San Mateo County at 27. You got the different things. So my concept is I'm trying to just point out the highlights. Everybody's going to have their own favorite metric. They can go look at that metric. This is comparing March. It's not quite apples and apples because obviously today's only the April the 1st, but normally I do this on April the 5th, but it's pretty close. What's interesting is now the sales in 2020 were lower than the current sales, and that's because of the pandemic. Remember, from basically March 17th to May 1st, we weren't supposed to be showing properties, and then we were able to show vacant properties at some point, and then on May 1st, I think it was, or close to that, we were able to show all properties with the different restrictions. Basically, April 5th of 2020, I don't believe we were allowed to show any properties. We might have been able to just start being able to show vacant properties, but you wouldn't have had offers accepted. So the fact that the only year that we're doing better than is 2020 is not saying very much. And on closings, we're still a record low because the pandemic didn't impact closings yet because of the lag time. And this is the record volume of sales. You can see that 2023, comparing apples and apples, we're at 1,704 and 2020 was 1,760. It's sort of surprising to me to see this. The previous slide was Santa Clara County only. This is Silicon Valley. So Santa Clara County sold fewer homes currently, but that means Alameda County most likely pulled it off and made up the difference, which is why this is still a record low volume. It's getting pretty close, and probably by next week, we will no longer be record low volumes. Now we're looking at the 3 key indicators. We're doing sort of a summary. Your inventory is down here, so your only at 70% of the inventory you'd expect. Your offers are down here at closer to 65%, but as a result of that, your days on sold inventory is coming in right where you'd expect it to be. So we're having a typically fast-paced market, but with just very little volume in listings and in sales. Here's the summary that we saw before, so you can look at the raw numbers for each one of your micro market areas and whatever metric you like the best. This is the URLs. I will skip over that. Now we're going to be moving on to the Greater Bay Area. We add in San Francisco and Marin as the city's micro market area. We add in the North Bay micro market area, including Sonoma, Napa, Solana, Contra Costa. We enter the Central Valley and the Central Coast. Here's the actual data. We're sort of doing the reverse order since we were just looking at this. You can see the median price for the different areas. This is the active inventory. You can see that inventory in all your areas is way down. I mean, you don't have to have an exact number to see. Your biggest two areas are up here at almost 5,000 listings, and now they're down at 1,500. So they have 1/3 the inventory, and that's Central Valley and North Bay. They have roughly 1/3. You look at Silicon Valley, it might have been about 2,500, and it's now at about 1,500. So it's a little bit better than a half, maybe 60%. And then you look at the Central Coast and the city's micro market area, and they've gone from 1,000 to 500, so they're about 50. Most of the areas are about half the inventory you'd expect. The big elephants in the room, the Central Valley and the North Bay, are 1/3 the inventory you'd expect them to be. Offers accepted, more reasonable. You could say maybe the big ones, the big three, you'd expect about 2,500, and you're down here somewhere around 1,700. So you're losing about 1/3 of the offers you'd expect. They're down a little bit in the cities and in the Central Coast, but not that much. Maybe they are down because the number's about 500 and I call it about 300, so it's about 60%. So everybody's down about the same percentage. Days on sold inventory, you can see the trend has been basically flat, and then we got into the superheated stuff. Then we slowed down last year, and right now we're very close to superheated. Silicon Valley has slowed down the most and is sort of back here in the normal. When you get out of the Silicon Valley area and look at the Greater Bay Area, you're actually in a hotter marketplace than they have been in most of the time frame. This is the 75th percentile, so the time that it's taking the sellers to sell. Despite Silicon Valley slowing down the most, it still has the fastest market, where 75% of the sellers are selling in about 28 days. You go up here to the cities, and they're coming in at about 35 days. Then you jump up here to the North Bay, and the North Bay is somewhere around 55 days. So that's a huge difference going from 20 to 55. That's the market's half as slow. Then you go to the Central Coast, and you're about 62 days. And finally, you come into the Central Valley, and there are about 67 days. You can see there's a huge difference in the counties. Even though Central Valley has very limited inventory, it had like 1/3 the inventory, the sellers there are actually taking time to sell the homes. They're up here at somewhere around 67, 68 days. This is the median days on market. I actually like the 75th percentile a little bit better. You can see they're much closer together here, so it's really saying the separation happens between this 50 percentile and the 75th percentile. That third quadrant is really where the spread is happening. Here's the sellers that are taking the biggest price reductions. You can see that they're not very large, and this is the 10 percentile, but the sellers that are taking the biggest discounts are taking about a 12.5% discount. The average discount is up here somewhere around 1.5%. So the average discount is very small. The magnitude of the overbid, so this is where the buyers come in and overbid. The area that's doing the best, the highest overbidding is the cities, followed by Silicon Valley, followed by the North Bay. But the cities in Silicon Valley are very close together at above 104%. Everybody else is at 100%. So I mean, that's a clear separation, and you're seeing that a fair amount with the data. You got another clear separation with the magnitude of the overbid. Then this is the median. This is half above and half below. Silicon Valley and the cities are up here almost at 101.5, 102. Everybody else is down at 100%. This is the smallest overbidding. So this is the ones that are coming in the most under asking price or the least above asking price, depending on where we are. So in Central Valley, sort of the most discount the offers are generating is about about 7.5%. The area that has the least discount is the Central Valley, which is sort of surprising. It has some of the longest marketing time and some of the least discount. I think that may be because a fair amount of the new builders are on the MLS and they're not going to be reducing their price. The largest overbids that you have, so now you're looking at the 90 percentile. San Francisco, the cities, is 20%. When you're overbidding 20%, you're pretty significant. At Silicon Valley, you're somewhere around 17%. The other three are way down here at like 5% overbidding. Now we have the frequency of overbidding in the 5 regions of the Greater Bay Area. You have San Francisco and Marin up here at the top, along with Silicon Valley, followed by the North Bay, and then you have at the bottom Santa Cruz and the Central Valley. So Santa Cruz and Central Valley, still over a third of the sellers, 35% of the sellers are getting more than their asking price. North Bay, the number increases up to about 44%, and then in Silicon Valley in the cities area, you're up to about 58%, 57% of the sellers are getting more than their asking price. Total appreciation, you can see that San Francisco and Marin, sort of the heart of the workforce area, has done the least well since 2015. That's the 9-month period of time in 2015 to current day has had the least appreciation. The area that's had the most appreciation is the Central Coast. It's skyrocketed just this last couple weeks, excluding that, which could be a perturbation because it's already on its way back down and there's so few sales in the Central Coast, is the Central Valley. So the more remote areas have had the better appreciations, then Silicon Valley, and then finally the North Bay. So the North Bay has sort of done the least well other than San Francisco and Marin. And that's the report on Silicon Valley and the Greater Bay Area in real estate and graphs and geographically, week number 13. We've gone over the root URLs. My contact information is down here. Happy to work with clients. And anyone have any questions? Not seeing any questions, I'll end the meeting and have a nice week, everybody. Bye for now.